One of the information, there's a lot of information requirements in the new federal healthcare reform, not just information flowing between employers and exchanges, but there's going to be information, more information in terms of notice information from employers or health plans to employees or to the government too about how plans are working and so forth. And one of those pieces of information is just a new requirement, and this is going to be effective March 1st of 2013, so that's where that is in the timeline. So basically, 9 months before the exchanges are in place, actually, the whole 9 months before, employers are going to be required to give written notice to their employees about these exchanges and the fact that the exchange exists. Hopefully it will exist, at least in some sort of preliminary form by then, so that otherwise, how can you tell employees about something that doesn't even exist yet? But even though it may not be up and running until January 1st of 2014, things should be well enough along by then that employers can satisfy this notice requirement, and the fact that they will be able to, come 2014, be able to purchase insurance from the exchange, and that if they do purchase insurance through the exchange, if the employee opts out of the employer's plan, they'll be able to do that. They'll lose the employer's contribution, but they will get this voucher that we talked about before to allow them to help pay for the cost of the insurance they might get through the exchange. And the notice has to explain other things too, like if you're a low-income person, you can qualify for the premium tax credit and other cost reductions and so forth. Question back here. Or is it still going to be deductible for the employer? Those are good questions, and the answer is that the vouchers, the cost of the vouchers, yes, will still be deductible to the employer, and just exactly as the cost for for-profit employers that do deduct these things. If you're a non-profit employer or governmental entity, deductions, of course, are kind of really irrelevant. But if you're a for-profit employer, the cost of what you pay for the health insurance coverage is certainly deductible. Likewise, the cost of what you pay out on these vouchers is going to be deductible. And to the extent that the full amount of the voucher is being used to purchase insurance through one of these exchanges, there's no taxable income to the employee. But if, and this could happen, let's say the amount of the voucher exceeds the amount of what the premium that the employee would pay for the insurance coverage through the exchange. If there is such a difference, then that additional amount will be taxable income to the employee. So if the voucher is worth $1,000 and they're paying $900 for their health insurance coverage through the exchange, that additional $100 is supposed to be taxable income to the employee. The employer still has to pay, yeah. The employer, even though the employee might have signed up for coverage costing only $900, and the employer would normally pay $1,000 toward coverage if the person were to stay on their own plan, which is how you determine the amount of the voucher, the employer still has to pay the full $1,000 voucher, pay the full amount, even though less than that is needed by the employee for the coverage they get through the exchange. That's right. The employer doesn't get off the hook.
What if the employee opts out of health insurance altogether?
And decides to pay the penalty, let's say, they're not.
Or goes on a spouse plan.
Yeah. And then the voucher becomes fully taxable income?
Yeah.
Still eligible for the voucher if they opt out?
Well, I think if they opt out of the health plan to be on a spouse's plan, for example, then I don't think the employer has to offer a voucher.
I think that may be right. I'm not certain about that. If the employer has coverage through the employee's spouse,
or an individual policy or some other coverage, maybe not through the exchange.
Well,
I wonder.
Yeah, I think it may only be applicable toward buying insurance through an exchange, as opposed to buying insurance, or helping to pay for insurance through a spouse's employer. I think it's just usable toward the cost of coverage through the exchange.
Right.
But it may well, there could be possibly situations, I haven't seen a summary that addresses this issue, but it possibly could be situations maybe where someone has coverage elsewhere and maybe can pocket the entire voucher amount, but that's not the way it's intended to work. It's intended to be used to pay for the coverage of the individual through the exchange.
I mean, a lot of employers have spent a lot of time getting their employees to go on a spouse's plan instead of their own, even incentivizing them to paying them cash to do it. do think that that will still be possible, though if that person ends up going to the exchange to get coverage, then I think your incentive to keep them out of your plan has essentially failed at that point.
My understanding too of how the vouchers are supposed to work is for the most part, the employer is supposed to be paying the money directly to the exchange, which should ensure that the money is being used for that purpose.
Right.
Now, how it works where, let's say, the cost exceeds the amount of the coverage for the exchange, so that the amount the employee will be taxed on, it's a little bit unclear. I mean, will that money go from the employer to the exchange, and will the exchange pay the excess amount to the employee? My guess is that won't be the case. My guess is if the employer's voucher is, say, $1,000, and in my example the cost of the coverage is $900, then the employer will know that's what the cost is. The employer would send $900 to the exchange to pay for the coverage, send $100 to the employee because they have to pay out that full $1,000, and then obviously then put that $100 on the person's W-2 then too, since they're supposed to be taxed on it.